Monetary policy in India refers to the measures adopted by the Reserve Bank of India, RBI, to control and regulate the money supply and interest rates in the economy. The primary objective of monetary policy is to achieve price stability, promote economic growth, and maintain financial stability. Let's explore the key aspects of monetary policy in India. Evolution of money. The barter system was the earliest form of trade, where goods and services were exchanged directly for other goods and services. However, as economies grew more complex, the limitations of the barter system became apparent, leading to the evolution of money. Money is a medium of exchange, a unit of account, a store of value, and a standard of deferred payment, which greatly simplifies transactions and economic activities. Monetary policy goals. The RBI's monetary policy aims to achieve the following goals. A. Price stability, controlling inflation and preventing deflation to maintain stable and predictable price levels. B. Economic growth, promoting sustainable economic growth and employment generation. C. Financial stability, ensuring a stable and sound financial system in the country. Inflation, deflation, recessionary, and inflationary scenarios. Inflation, it refers to the sustained increase in the general price level of goods and services over time. Moderate inflation is generally considered beneficial for economic growth, but high and unpredictable inflation can distort economic decisions and erode purchasing power. Deflation is the sustained decrease in the general price level of goods and services. While it may seem beneficial for consumers, prolonged deflation can lead to lower consumer spending, decreased business investment, and economic stagnation. Recessionary scenario. This occurs when an economy experiences negative economic growth for 2 consecutive quarters. It leads to reduced consumer spending, lower investments, rising unemployment, and slower economic activity. Inflationary scenario. An inflationary scenario is characterized by rapid increases in the price levels of goods and services, leading to a decrease in the purchasing power of money. Monetary policy tools and money supply in India. The RBI uses various monetary policy tools to influence the money supply and interest rates in the economy. Some of the key tools include: A. Repo rate, the rate at which the RBI lends money to commercial banks. Lowering the repo rate makes borrowing cheaper for banks, leading to increased money supply and credit availability in the economy. B. Reverse repo rate, the rate at which the RBI borrows money from commercial banks. Raising the reverse repo rate reduces the money supply as banks find it more attractive to park funds with the RBI. C. Cash reserve ratio, CRR. Banks are required to maintain a certain percentage of their net demand and time liabilities as cash with the RBI. Changing the CRR affects the liquidity in the banking system. D. Statutory liquidity ratio, SLR. Banks need to invest a specific percentage of their net demand and time liabilities in approved government securities. Changing the SLR impacts the lending capacity of banks. A. Open market operations, OMOs. The RBI buys or sells government securities in the open market to influence money supply and liquidity. Monetary Policy Agreement in India. In India, the Agreement on Monetary Policy is laid out in the Monetary Policy Framework Agreement, MPFA, between the RBI and the Government of India. The MPFA outlines the objective of maintaining price stability and the institutional framework for monetary policy decisions. Sure, let's dive deeper into each aspect of monetary policy in India with examples. Evolution of money. The barter system was prevalent in ancient times when goods and services were directly exchanged for other goods and services. For example, a farmer might exchange a bag of rice for a cow from a cattle farmer. However, this system had limitations. It was difficult to find double coincidences of wants, and the lack of a standardized medium of exchange made transactions cumbersome. As societies evolved, they recognized the need for a more efficient and widely accepted medium of exchange. Precious metals like gold and silver were used as money due to their intrinsic value and durability. Over time, various forms of money evolved, including coins, paper currency, and eventually digital money like credit cards and online transactions. Monetary policy goals. Let's consider the example of inflation and economic growth as key goals of monetary policy in India. Example: controlling inflation. Suppose India experiences a surge in oil prices due to geopolitical tensions, leading to higher production costs for businesses. This situation can trigger cost-push inflation, where the increased cost of production is passed on to consumers in the form of higher prices for goods and services. To counter this inflationary pressure, the Reserve Bank of India, RBI, may decide to implement the contractionary monetary policy. They could increase the repo rate, making borrowing more expensive for banks. As a result, banks might raise their lending rates to customers, leading to reduced borrowing and spending by consumers and businesses. This decrease in spending can help curb demand, pull inflation and stabilize prices. Monetary policy tools and money supply in India. Example, repo rate and open market operations, OMOs. Suppose India's economy is facing a slowdown, and the RBI wants to boost economic activity and credit availability. To achieve this, the RBI can lower the repo rate. Let's say the current repo rate is 5%, and the RBI reduces it to 4%. As a result, commercial banks can borrow from the RBI at a lower interest rate. Banks can then pass on this benefit to consumers and businesses by lowering their lending rates for various loans, such as home loans, car loans, and business loans. Lower interest rates can incentivize borrowing and spending, stimulating economic growth. Additionally, the RBI can use open market operations, OMOs, to inject liquidity into the financial system. It can purchase government securities from banks in the open market. When the RBI buys these securities, it pays the banks, which in turn increases their reserves. With more funds in hand, banks can lend more money to individuals and businesses, further boosting the money supply and economic activity. Monetary Policy Agreement in India. Example, Monetary Policy Framework Agreement. The Monetary Policy Framework Agreement, MPFA, between the RBI and the Government of India outlines the objective of maintaining price stability and the institutional framework for monetary policy decisions. Suppose the government and the RBI agree on a target inflation rate of 4% annually. If the actual inflation rate exceeds this target, the RBI might take necessary measures to bring inflation back to the agreed upon level. This could involve using the monetary policy tools, as discussed earlier, to control inflationary pressures and ensure price stability.